Okay, so moving on to our real estate returns. And again, it seems a bit strange to me because we would normally be covering a lot of this material in alts. It's very, very similar in many places. One of the things they often like to do is think about a direct investment in real estate versus an indirect. And when they say, of course, a direct investment in real estate, we're talking about a big lump of property, a big piece of property in this way. This building that we're in here in London, which of course is immobile and hasn't been bought or sold, and of course in many years. So a big direct investment in there has this problem perhaps of being quite illiquid, and it's definitely unique. Yeah, definitely a unique characteristic coming in here as well. Now, unless you are a very wealthy investor, unless you are perhaps an institutional investor, your approach may be much more limited to more of an indirect approach here. For example, going down the index approach, something like a real estate investment trust, so you can get a smaller investor can get access to a similar kind of idea. Now, I would also link in, guys, here GIPS as well, just the Global Investment Performance Standards. And just to mention that, remember, guys, that direct investments in real estate, also investments in private equity are covered separately in GIPS as well. Have a good read over those as well too. So you have to maintain them, guys. The investment services, the managing the properties can be quite a lot of work as well too. And we come back to one of our main data issues and valuation issues, which are appraisals. Now, the issue of smoothing, these smoothing problems mentioned here, is the idea of a lack of transactions. This idea of the volatility that's smoothed here, the volatility, guys, will be smoothed downwards quite famously. And when you look at the impact of this, when the market's rising, then the values go too slowly. When the market's falling, the values go too slowly as well. So looking at the overall, we're very impacted here by the economic and the business cycle coming in here. We've seen quite a lot of this in many of the other asset classes as well. Of course, in the boom times here, values are rising, not just for the property itself, but also, guys, the leases as well too. In the upturn, you're having to pay more. Lease rates, etc., you have to pay more for those properties too. The whole economy is booming, so construction values, the costs start to rise as well. In the down period here, the opposite, overcapacity, overbuilding, and values and rates start to fall. There can be a lag depending on the length of the leases, of course. Now, many of you might recognize the term cap rate, but let's just define this and make sure that you're very clear here. When we have our net operating income here over our property value, guys, we get ourselves our cap rate. And we know that the cap rate depends a lot on the location of the building, the type of use of the building as well. And that idea of comparables is quite useful too. And the net operating income, unlikely we're asked to calculate this in any detail, but it is before interest. Think of it, guys, a lot like an earnings before interest and tax. It's an operating income measure. There's no financing in there at all. Net operating income. So our ideas are comparable here, used very, very widely. You can look at the building next door. Here we are in an area of London. And that particular area, you could compare perhaps to something comparable or similar that has recently perhaps been sold. Yeah, if you have a value that you can use, you can look at a comparable in terms of the size and square footage and usage and condition, that kind of thing as well. And you can work out a reasonable cap rate. So cap rates are a lot like discount rates, reflecting the risk involved as well. Let's just link in some prior knowledge that you know already. And let's go back to an old favourite here, our Gordon's growth, our constant growth model. So guys, our constant growth model is everywhere in economics, and here it is again, where we know that we have the price or value today being the dividend, next dividend over the R minus G, our required return on our growth rates. And if we rearrange this once more, remember how we have our expected return here, and just one more time, I know you know your way around this very well, our D1 over the price, guys, plus the growth. And so what you have here, as we've said, is you have the yield. You have the yield plus the growth. So the cap rate, guys, here being the yield over the growth. So it's no different really to our Gordon's growth idea. There's two components, our yield and our growth rate coming in here, giving us our expected return. I'm getting a lot of value out of our Gordon's growth model there. Now, the thing about the Gordon's growth model, it's a constant, unlimited growth, kind of perpetual. But what if you had a limited, more of a finite time period? So a little adjustment, guys, here. We have the first two components, and then this idea of a finite time period, the little adjustment on the very end as well here. Think of the cap rate on the slide like a long-term discount rate. Okay, so thinking about the premium approach, goes the idea of the building block approach. We've seen this before a few times earlier on. Think of those four components. So you've got the term premium, thinking about longer term assets coming in first. You've also guys got the credit aspect coming in as well. Thinking about the tenant risk coming in, a potential non-payment. When they talk about credits, always bear in mind the kind of expected losses, PD, LGD, and exposure at default. Guys, probability of default, loss given default, exposure at default as well. Remember the expected level of loss, and the mean or average loss, if you like, as well coming in. If they ever talk about credit loss, remember guys, credit loss, the first two components there, PD and LGD. So you see a lot more of that in the fixed income area. About anything involving credit, we're going to, a quick reminder. And then some kind of number three, an equity risk premium as well above corporate bonds for fluctuations in real estate values too. And finally, it is quite illiquid. You've got that liquidity premium too. One thing to talk about is that a link to alternatives here. So with alternatives, they often talk about that something like infrastructure. Something like infrastructure has kind of three components there, where you have a private equity phase, a real estate phase, and then a fixed income phase. So just to draw a quick link to this, that when we're talking about real estate, they're often thought of here kind of returns as being relatively consistent. The risk has certainly fallen from the private equity phase, but still higher risk over, say, something like the fixed income area here. So watch out for those four premiums. And finally, let's link into direct versus indirect here. Here we go. So down the direct route, you're buying like a wealthy individual or an institutional investor, pension fund, endowment or foundation. You're buying in directly into a piece of real estate yourself. You're buying in straight away. Whereas if you are perhaps a smaller individuals, less wealthy individual here, guys, you might invest in a real estate fund like a REIT. Now, remember with a REIT, it's a PLC, it's publicly traded, and a small investor can invest in much smaller amounts. You are getting, of course, in the short term here, a high correlation with equities generally. If the market's been fluctuating, then your real estate will fluctuate as well. But over the longer term, guys, the book is saying here there's quite a high link between the direct real estate investments too. So if you're investing in a fund, a real estate fund, over the longer term, it should behave a lot like a piece of property that you might buy directly. Okay, so the text finishes with some data. It's quite interesting in this area here, looking back over the period. And they say that residential real estate, I guess the largest component of most of your average clients' wealth overall, no surprise, it's the largest class of developed properties there, far more than commercial. Look at that, 75% of global values. And overall, residential outperformed equities on an inflation-adjusted basis with lower risk, which is interesting. However, just beware the risk. Is that based upon appraisal data? You know, if that is heavily based upon appraisals, which it probably is, then the volatility is going to be quite low anyway. There's a very famous index in the US called the NPI, the Necreef Property Index, and the volatility is extremely low because of that valuation problem. But we know the time periods here comparably weaker. Think about the subprime, think about the crisis, comparably quite a bit weaker over that period. One way to think about it, that even real estate has a negative skew, that there can be time periods, guys, when you get these events coming along, so it's no surprise to have these down periods too as well. Lastly, that these returns weren't correlated across countries too much after World War II, whereas the equity returns with perhaps with globalization were a lot more linked together.